Joining us now, Logan Mohtashami, HousingWire lead analyst. And I guess the first thing you can talk about what the Treasury Secretary alluded to, or just respond to the numbers that we just heard from the federal government.
You know, single-family permits have been going lower and lower for some time now. The big publicly traded builders can still buy down rates to get below 6% to move product, but the smaller builders are at a disadvantage here. Multifamily construction has already had a very big crash in starts, so they're working from a very, very low level. So when you see these big housing start prints, they're very volatile. Simply put, mortgage rates are too high to get things moving again. If you can get rates down to just a 6%, the builder stocks are starting to outperform a little bit. Housing does tend to act better towards 6%. It's just being able to hold it there enough to get things going. So it is a rate story. And if the economy gets a little bit softer, maybe on the labor side, you can maybe get rates down to 6%. But outside of that, we've just been basically stuck at very low single family permits for some time now.
I mean, it's, for some reason, Logan, six seems to be the level where no one's saying 5.5 or 5 at this point, like anytime soon.
Yeah, it's really hard to get sub 6% mortgage rate with Fed policy where it's at, and especially where inflation is. But in the last few years, when mortgage rates go from 6.64 down towards 6%, new home sales tend to act better. Existing home sales tend to act better. We're still very low on the existing home sales side, but the new home sales market is still at 2019 levels, right? They've basically been in a sale range since 2018. So there's demand there, but whenever rates go back up to 7%, we see it fall. Whenever rates go back down to 6%, we see it do better. I know Home Depot talked about, people are pausing on their reconstruction or renovation projects. So residential jobs are starting to roll over now. That's not a good sign with the economic cycle that we've seen over the last 4 or 5 decades. So just getting down to 6 is the most realistic thing we can get in this kind of environment where Fed policy is. So it'll help a little bit. It won't be a housing boom or anything in that regards. But you can grow new home sales a little bit. You can grow existing home sales just to get the single family permits going again, because it's going to take time to get these homes starting to build and get them out there as real supply.
You said that with current Fed policy, Murda, are we guaranteed that if we cut, we'll get a point-for-point drop in the mortgage rate based on what we do? That doesn't necessarily mean we can get below 6% if the Fed starts cutting, does it? Could go the other way.
I think a lot of mortgage pricing getting better recently has already anticipated that. We had a 2% move from 2023, from 8% down to 6% in 2024 with no rate cuts. So really the bond market tends to get ahead of the Federal Reserve. Federal Reserve always tends to play catch up in that. So I think a lot of the good pricing so far has been put in. To get lower mortgage rates with Fed policy here, you need weaker labor data. If labor data starts to pick up and core inflation starts to pick up, you can move up a little bit more, but we're kind of where we should be with mortgage rates and where the 10-year yield is. The positive story in 2025, though, that wasn't the case the last few years. Mortgage spreads have gotten better, even as the 10-year yield has risen the last few trading days. Mortgage pricing hasn't been hit so much. That is a real positive story going out, not only for the rest of this year, but for 2026. If spreads could just improve a little bit more, you don't need that much help from the 10-year yield to get low 6 mortgage or get rates down to 6%.
Logan, none of this sounds great for if you're a young home buyer or a young family. It seems like everything's going the wrong way. Is it over for them? I mean, we always say that, but
I mean, in real terms, let's think about it this way. We have near 5 million total home sales. In the peak of the last decade, it was near 6 million. So we're missing roughly 1 million mortgage buyers. If you look at the history of housing economics going back decades, there's always been periods of times where home sales crash, they stabilize, wages grow, household formation grows, rates go lower, demand picks up. We just basically rinse and wash and do it all over again. So it's not over. We had a similar situation in the 1980s when affordability was worse there. But over time, wages grow, household formation grows, dual household incomes come in. As long as price growth cools down, it looks a little bit better going down in the future. And again, We don't need 3, we don't need 4, we don't need 5. But if you want to get single family permits going again, you want to get housing construction going, you want the jobs that are being lost to reverse, you probably need mortgage rates just to get down to 6% and hold it with duration. And now that mortgage spreads have improved, that's going to be a positive going out into the future. It's just that last leg down.